Welcome back, everyone, to another Beyond Moon episode. Today, I get to have a conversation with a young man named Bill Bean. Happens to be about 64 years old, and we're going to talk about his investment strategy and what he calls his liquidity plan. That's his way of capitalizing on the profits from his digital asset investments. He discusses how he went from holding over 50 cryptocurrencies and through a systematic process, getting down to all his holdings now are in one asset. Yes, Mr. XRP. So we're going to have an incredible conversation. Stay tuned. I want you to know that below in the description, Bill is offering free to anybody who wants it, one of his 7 books that he's authored. This one is called Living on Purpose. And that ebook will be available in the description of this video. I thought that was a very generous thing for him to do. I hope that if you find Bill to be an interesting human being and have value for you, that you'll take the opportunity to take his book, and hopefully it'll add more value to your life. And if not, that's cool too. But that conversation with Mr. Bill Bean's coming up right now. So Bill, thank you so much for taking the time to share with me today. How are things going for you?
Going really well, and I'm really glad to be here with you.
Right on. Well, one of the elements of this Beyond Moon series that I've put together is to bring a cross-section of the audience from different demographics, different social economic backgrounds, to share their quote-unquote exit strategy or capital strategy as it pertains to how are they thinking about capitalizing on their investments, and what an incredible opportunity to get to share with you today, coming from the fact that you've been in business for yourself and for others for many years. You're representing the baby boomer generation. And it would be really neat to kind of go through and take a look at, number one, kind of your investment strategy into the digital asset space. And then we'll transition into the capital strategy for how you intend to utilize those profits. And we'll just go on, one thing leads to another type of deal. So why don't we kick it off with your investment strategy, diving into the cryptocurrency space, and maybe even a short story when you got started, what attracted you, etc.
Yeah, very good. The background of me is that I started out as an English major at Penn, transferred to Brown to be closer to my girlfriend at Wellesley, and it was a creative writing major, and then ended up in Boston College getting married and being an accountant. So my career has largely been as a creative accountant. And real quick, I was with IBM for 10 years and became one of the leaders in the financial sector. And then since then have run a couple of companies, but also since 1992 had a strategic planning company in the strategic planning arena, and written about it and so forth. About 11 years ago, I realized I need something I can do at home without jumping on a plane. And that got me into foreign exchange. And I took about 11 courses in it. But the more I got into it, of course, I had a lot of experiences. When crypto came along, I was already in the framework of an investor and also of a trader, and having experiences in both. When crypto came along, and this was when fourth quarter of 2017, that's when I really got interested and made the financial commitment into digital assets, I believe starting in late October, early November. So I caught that whole moonshot up, and then the subsequent collapse over the last 300 days back down. So that is how I got into investing. And I got into it because of a general sense that the biorhythms of the stock market, while they would pump I did not like the long-term projection of what I thought would happen in those markets. And when I looked at foreign exchange, I really felt like there was more opportunity in the best cryptos. So that's how I got into the space. And I made an allocation, and I started out in about 40 different cryptos. And over time, it focused down ultimately to one.
Ah, interesting. So actually having experience as an FX trader, trading from your home terminal, you're very well knowledgeable and have a ton of experience in dealing with not only the currency markets, but all of the knock-on effects of trading in a market where you're using a ledger,
Mm-hmm.
and that ledger doesn't have associated value for several days after the fact, right? In the form of, so maybe as a side note, walk us through a trade start to finish.
In the crypto realm?
Market.
Oh, in the FX market, right. Firstly, choose the best experts to get their guidance on fundamental news and technical analysis. That's very important, is to not be winging it completely on your own, number one. Number two, get calibrated on you have a set of 4 to 8 pairs that you like, say USD to Euro, and look across those pairs and see which ones seem to be the most volatile and have the most opportunity. Then you choose that pair and you look at the best, where you think that pair is going in the time frame you choose to trade in. And then after that, you look at the best entry point and exit point. You lock that in with a trailing stop loss. Stop losses are critical because of volatility. And then you let it run. And like most people, it's hard to break over 50% success, but if you narrow your stop losses and have very good setups, over time you will make money on it.
Well, let me ask you this, because I was kind of more, and that's wonderful, thank you. I'm kind of looking at, okay, walk me through. So obviously you have your criteria. Right. You have your market that you're going to operate in. Let's, for instance, say that one of the corridors for me, and I'm an FX trader, is the Japanese yen to the Thai baht. Mm-hmm. That's a currency corridor I've chose to trade in. Now, when I take a position in FX, am I allocating it's a certain amount of dollars? Mm. Is that how this works? Like I'll say, I'll operate in that corridor with $10,000, or right. I mean, I don't understand the dynamic.
Yeah, so I did not allocate dollars by corridor. I had a select number of corridors, which essentially were 4 or 5. Okay. And they were the ones that had the most throughput, the most traffic, the most volatility, the easiest to trade on. And I had a total pool of money. And on any given trade, I would only commit 2 to 5% on it, because obviously I didn't want to lose my base or a majority of my holdings in one trade. So that's how I did it. I basically allocated a total amount, came up with the trading pairs, and each time it'd be 2 to 5%.
So in essence, it's not unlike trading any asset. Right. You're basically trading the assets. You're not providing liquidity in a corridor.
That's correct.
Okay. Now I get it. Now I understand. Okay. So here you are. You've paired. We're going to back to crypto. Mm-hmm. You have got yourself down to one asset. Walk me through that process of entering the space, spreading money around, and then as time went by, scaling down your holdings to now that you only have one. How does that process work for you? Give us a peek behind the curtain.
Yeah, great question. Firstly, I think it really helps to have a journal. not for bureaucracy's sake, but you really understand how it went down and what your logic was at each step of the way. Firstly, I have to say I selected the best expert advisors. And I have to say, net, Tika Tiwari was the best advisor that I could find in the crypto space at that time in 2017. Did have to spend about $3,000, something like that, to be an insider with his analysis. Meanwhile, I've been picking up from other experts their cryptos, saw overlap validation, as well as reading the markets, reading utilization, reading technicals. So that's how we got off. And I ended up ultimately, I think at the high water mark, I had 50 cryptos, Jerry, at about 2% of each. So I really hedged my bets on that. It did start to boil down. And the factor of boiling down was what I felt personally was the disproportionate attractiveness of XRP. As it started to become, to me, distinguishingly attractive, I started whittling my list. So then by, I would say, mid-late 2019, I went down to 10, and then I went down from 10 to 4. And I actually, I have to explain also, I actually had 4 tiers. So I had XRP as my main holding. And when I developed the tiers, I even had up to that time 60% in XRP, 40% in the remaining tiers. Tier 2 is Ethereum, VET, and BTC. The third tier was Crypt, KNC, BAT, RCN, Link, Tezos, and ZRX. And then I had a 4th tier with about 10 more. Now, as I continued to study the market, it became clear to me that I needed to refine. So I went from 60% XRP to really dropping the 3rd tier and the 4th tier, and ended up with just a very few of the assets, Tezos, Link, and VET. Then, and this was in December of 2019, as I continued to do the analysis, Jerry, I think utilization was the big trigger. XRP really was delivering the actual progress of utilization. And by late December, early January, I was also thinking of capital gains that I did not want to be trading a lot in this year. I wanted to lock it in by year end 2019. I moved everything over to XRP. My initial holdings were about, say, 200,000. It grew from, say, 100,000 units of XRP up to 200,000. And then, as we'll get into a little later, as I consolidated everything in, it even became more in XRP, but I'll explain that when we get to the next segment on Nexo, et cetera.
Well,
does that make any sense?
Yeah, well, it makes a lot of sense. And I'll tell you that there are a lot of one-line pieces, one-liners. People will state one-liners.
Right.
And many people give these one-liners coming from a place of trying to be helpful, right?
Mm-hmm.
Wanting to be helpful. It's genuine. I don't think that there is one malicious element to it. However, when I hear people say things like, you got to diversify, or you've got to do this, or you've got to do that, it kind of scares me a little bit, because number one, there is no one size fits all. There is no one statement that works for everybody.
Yes.
There are, strategies, and each strategy may have its pros and cons. Some are demographically oriented, some are socioeconomically orientated. Mm-hmm. Everybody needs to judge for themselves what's best to produce their desired goals, right?
Absolutely.
To produce the results that meet their goals. So maybe before we transition to the next thing, let's take a look at what were some of the goals you entered the space with, and how have they adjusted over the last 2 years?
Yeah, it's another great question. Firstly, I really do agree with those that say diversification per se is valuable. My macro construct is real estate, gold, silver, and for me, crypto. And then in the crypto space, I also diversified down to like I said, starting out with 50 with a very safe allocation. And I don't believe that one should put all of one's eggs in one basket reflexively or as a matter of philosophy. But
Right.
XRP, it was like a tennis ladder where you're challenging the one that's ahead of you, and you continue to beat it. You go up, 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 up. And as you do, things are taking their place. And in this case, to me, as significantly inferior to XRP. And the main thing on that, I'll just cut to the chase on that, was multiples. If you take, this is critical. If you take, for example, and by the way, I hope all of the valid cryptos succeed. I am not one of those maximalists that has to minimize everything else because of the existence of the one you like better. But say you take BTC. If it goes from 10,000 to 50,000, those are 5 turns. You get five turnover from that, 5x in multiples. Say Ethereum goes from 400 to 4,000. That's 10x multiples. Say XRP goes from 20 cents to $5, which is not absurd. If you look at all the data points of the experts, that is a 25 to 1 return. It was that kind of analysis that caused me to whittle down the choice and to increase the placement of more into XRP. Long term, we'll get into that. I would want to continue to diversify outside of cryptos, and I would also look to see who are the emergent winners within the crypto space and divert funds over to those ones as they continue to manifest, really kind of like XRP already is.
Excellent. Very well said. Thank you. So now here we are today, and how you came onto my radar was when I rebooted this Beyond Moon series, and I had a Gen Xer on, 45-year-old man, talking about his quote unquote exit strategies. And we were talking about different things and possible goals and things that you may want to look at or think about. You left a very insightful comment in the comments section, and we've since connected on Twitter and now on the phone, and here you are in studio with me doing a show. The one of the elements that you brought up in this comment, and I thought it was really pertinent to discuss, was a way to capitalize profit may not be by selling, maybe by leveraging in other means. And so I want to give you an opportunity to really flush out that concept, that idea, that statement, because I believe for some people in some circumstances, it's going to be a very valuable tool to have in the toolbox. So I'm going to turn it over to you to take it from here.
Okay, great. And I'll just firstly share the concept and then how I've implemented that concept in a practical way. I think net, it's like those ads that we had in the States. This is your brain, this is drugs, any questions, where he drops an egg onto the fryer, basically saying that drugs will fry your brain. The simple picture is this. If I take the value, the growing value we hope of, in this case, XRP, and I collateralize it with a source, and that source will enable me to borrow from, based upon the collateralization, say up to 40% of what it's worth. That will allow me then to borrow and say it's a reasonable interest rate, in this case 5.9%. That would, let's just say that I withdrew $100,000 and had it for a year. That would be at full price $5,900 in interest expense. Now compare that with selling $100,000 of XRP that has thankfully grown, and at that moment something very significant has happened. A tax event has happened. And obviously all nations are different, and you need to know your own country's nuances, obviously. Right. But in the United States, there are 3 points. Number one, a tax event is when you sell. Number two, you really need to have a very serious gate upon that, because that is a big event. Number two, if you do not hold your capital for a year, then it is taxed as personal income. And say you can use in the United States, say 35%, but say just for simple purposes, it's 30%. That means that you could be paying $30,000 on that $100,000 liquidation event. Now, if you hold it for over a year, then it is a capital gains event, and that is taxed at lower levels, say for purposes of this discussion, 20%. So now it's gone down from $30,000 to $20,000 or $35,000, whatever. Take that $20,000, even at the lower rate, and compare that to $5,900, which is the interest expense that the lending source is requiring in order for you to borrow against it. And you can see that that is a much cheaper avenue. You're avoiding, the legal and tax event, and you are getting access to your capital along the way. So that's basically the concept, Jerry, in its simple form.
Well, simple math, right? Third grade math. If the cost to carry the loan is $5,900,
right,
the cost to extract the capital is $20,000.
Right. Yeah.
I can easily see that it's 75% more.
Yes.
Cash it out. Okay, great. Now, there are two other elements involved here. And I don't know if you brought those. I can't remember if you brought those up in your statement. I'll bring them up now because they're definitely germane. And that is these third-party entities. Now, keep in mind, and I'm just going to say this because it's not directed at necessarily you, Billy, but the world. Anytime you go outside of your own cold wallet, you're taking a risk with your digital asset. That needs to be said. Okay, great. If you've weighed the risks and you're making a decision to do something like leverage a Celsius platform or a Nexo platform or a Cred Earn platform, or maybe some new DeFi platform, and they have the opportunity to earn on money, crypto that you lend them. For instance, I did some math looking at, after reading your comment, and I was realizing that you could literally get a zero cost to carry by, for instance, if you took a round number like 100,000 XRP,
yes,
and you borrowed against it at 5.6, and you're also lending it to them, so you've lent them the entire 100,000 at 4%. That's $4,000 a year.
yes,
right?
Yeah.
If you keep your amount that you borrowed below the repayment margin, you could literally get a zero cost to carry, because the offsetting interest of the underlying asset is covering the interest payment of the loan that you've borrowed.
Yes.
That may very well be a way to borrow for free.
Yeah, that's a great point.
I thought about. Obviously, the levels are different. You could not borrow $100,000 on 100,000 XRP at $5 a pop and still be earning enough to carry the cost to carry on 100,000. But the math works out where at 60,000 you can.
Yeah.
At $60,000 you get a zero cost to carry. Now that may be advantageous depending upon what credit markets look like, depending upon any, I don't know what the tax code's going to look like a year or two from now. Who knows what the new administration's going to do, if there is one. I mean, there are a lot of variables, but the point is we can only go off of what we have right now. And you bring up a good point. And for somebody sitting in your position, within your demographic, you're not necessarily looking for growth over growth over growth. You're looking for stability and income assets, a way to derive income into your daily balance sheet so that you're able to carry the quality of life that you'd like, because you're no longer going to be putting in 60-hour weeks. You're no longer going to be flying around the country
or Earth.
Clients, new client acquisition, all the things that independent consultant analyst type people have to do to keep their business going. These are things you're winding down.
Yes.
Right.
Yeah.
And that's an important distinction to make. So what's good for the goose may not be good for the gander. A 45-year-old guy in his prime earning years is going to have a completely different approach to this than you are. But let's take a look. Let's take it one step farther. Let's say that the A, B, and C framework that you're kind of thinking about right now actually presents itself to be a viable option for you. And now all of a sudden you are able to capitalize large chunks of money with a pretty low cost to carry on the capital that you've borrowed. How do you plan to utilize those assets? Are they just going to be money in your savings account, or are you looking at funding other income producing investments?
Yeah, another great question. And I wanted to put an insert in that's a fabulous anecdote, and I'll do it quickly. The reason why I put 100%, the reason why when I took this strategy to get the maximum amount of loan leverage immediately was the following. As you know, in March, there was a flash crash. In that flash crash, I lost about 50% of my XRP units because of the way the loan was established. It went down, as you know, from say 20 cents to 11 cents, et cetera, et cetera. And so two things. Number one, I wanted to get the most XRP I could. So I had my money in there, and then I also loaned against it to get more XRP. And that was a good strategy. The flash crash caused obviously a big disruption. But here's what happened. I had to put in about, in this case, $6,000 more, which wasn't pleasant. But in doing so, the company that I was working with, in this case, Nexo, they worked out a way of rebuying so that I could get back up even slightly higher than my total holdings, which were over 300,000 units. And so that worked out very well. But that's why I was so aggressive on the loan to begin with. And one other thing, I checked it out carefully that Nexo has a very significant insurance infrastructure, and also they have had a sterling reputation in the market. And that was the way I tried to manage risk there. Now, in terms of what I do with the proceeds, and even say I don't pull out money for tax events, I loan against, get that 40% out and working, it would go into 4 categories. Number 1, real estate. Number 2, gold. 3, silver. And 4, the most attractive cryptos that have emerged that show the same kind of multiples upside that XRP did in this stage. So that's basically the summary of what I would do.
That's really interesting, and I'll tell you, I'm shocked. The reason why I'm shocked is, generally speaking, somebody in your demographic isn't making a lot of capital appreciation plays. They're making passive income plays. They're making income plays. You know, they're buying dividend stocks that have a track record of continuing to pay their dividend year over year over year without reducing the dividend, and on a consistent periodic time frame increasing their dividend. Bonds, gold, obviously, depending upon the market, can be an appreciation, can be a way to preserve your capital. Obviously, in a highly inflationary environment, gold retains purchasing power very well. And we all know that this economic experiment known as quantitative easing since 2008, nobody really understands the outcome of this thing. I mean, obviously the top economists that work for the Fed don't understand it, because they just keep doing more of the same, and it's not, the desired results aren't being produced, right? It's not we don't have 2% inflation. We don't have 3% unemployment. We don't have, 4% GDP growth. None of their little formulas are working. So
no, they're not, except the only thing we have is a weaker dollar, we think.
a weaker dollar. Thank you very much for having me. So
Yes.
So I'm walk me through the process, because I know you're a smart man, and I know that you can see that 90% of everybody in your age demographic is out of capital appreciation plays and are into income plays. So what's the nugget that you think you found that your peers aren't seeing?
Well, another great question. I took your question on investments literally, and that's why there was a little bit of a disconnect. And that's why I got into the allocation framework as compared to the total pie framework. In the total pie, I have other sources of recurring income. So that is being solved outside of the crypto space.
Oh,
number one.
Okay.
Number one. Number two, I really believe in having risk funds. So that means 6 months, 12 months, always have a pool of money that is available, so that if anything else happens that is a surprise, I have this bank that I can pull from that is there. As you know, the interest rates, the bonds, interest rates and savings instruments and so forth, they are so pathetic that it causes one to be more entrepreneurial perhaps than one would be. But net, it's outside of the crypto portfolio that you make these other plans in terms of getting recurring revenue. The other thing is you are betting on the sustained upside. And I think that is a danger if you're trying to rely on it for your income. But if you do your research and you have a long-term framework, it usually works out. Now, that flash crash was a very good example of how you can be surprised and hurt. And that's a very good educating warning, isn't it?
Well, I'll tell you, I got educated from it. I had a Nexo loan at the time with Nexo. And here's the thing, and I accept full responsibility. I too had a liquidation event. And I'll just, here are the numbers. So I had 7,000 XRP liquidated at 11 cents. Now that represented 7,000 XRP for $880 of value, of US dollar value. Here's the thing, I had sitting on Uphold more than enough XRP to shift over to Nexo so that event would have never happened. Here's the thing, those 7,000 XRP that covered $880 worth of US value actually had a net cost to me of $3,500.
Wow. Explain.
It cost me $3,500 for those 7,000 XRP.
Oh, okay, because of the liquidation event?
No, it had nothing to do with the liquidation event. When I bought the XRP, it was at 50
Oh,
cents.
Gotcha.
It got liquidated at 11.
Yeah.
But that doesn't discount the fact that I spent 50 cents on each one of those XRP.
Gotcha, yeah.
Now, I learned a big lesson there. I learned, one, never ride the margin that tight. Always give yourself more room. And so, for instance, I've done a regression model for Nexo for XRP collateralization, and this isn't a Nexo commercial, ladies and gentlemen. This is just one guy walking through a process of how to leverage loans and put myself in a safer position. Yeah. And that is this: 100,000 XRP, I'll borrow up to $6,000 at 5.6%, leaving plenty of XRP in the unloaned against department to cover the cost to carry. So I can literally borrow 6,000 XRP for free. $6,000 for free. And for every $100,000, it's a penny of movement up and down in price. So XRP has to go to 6 cents before I'll get liquidated.
Yeah. Yeah. That's a very wise.
I know this ahead of time, right? I don't need to go to their site to understand this. So if XRP gets down to 14, 15 cents, I know to refortify my position or pay off the loan.
Yep. Exactly right.
One or the other.
Yeah.
So add to my position which increases my buffer to margin,
Yeah.
right?
Mm-hmm.
For those folks that are getting confused by what I said, I'm augmenting the loan to value ratio. That's all I'm doing.
Yeah, exactly.
And so that was one way to skin it. And so I'm looking at this as a way to, what is the safest way to leverage my holdings? Because I'm in a position where I don't have a lot of money coming in. My income years are behind me, right? And so I have to think about this. You know, if you're young and you got a job and your dollar cost averaging into this market, excellent, good job. I think this market's got years to grow. This isn't going to be some 1 year, all the gains are going to happen. And if you weren't in it, oh, well, too bad. I don't think that's the case at all. I think this is a growth industry. I think I think we don't even really understand the magnitude of what this market, and I'm talking about digital assets as a whole, what this market's really going to truly look like in 10 years. So
Agreed.
With that being said, I think there's tons of growth ahead. However, we have to live in the now. I can't live 10 years from now. I have to live in today.
Right.
And one of the things that I was looking at is leveraging more money to acquire more of these assets, as I believe they're on the cheap. And with the price dynamic of XRP, take the percentages aside, just don't even think about percentage. Think about dollars as a unit, so currency units and asset units. And if you look at currency units and asset units, we are currently trading in a range where there is a tremendous amount of difference between 30 cents and 20 cents.
Yes.
Right?
Yep.
Between 33.3 cent XRP and 20 cent XRP, when you look at asset units and currency units, there's 4, 3, and 2. I'm sorry, 3, 4, and 5.
Okay.
For 20 cents, I get 5 units. For 25 cents, I get 4 units. For
Exactly.
30 cents, I get 3 units.
Exactly.
That, believe it or not, that structure in this price range that we're in, no other asset has that right now.
Yeah.
Right? You have to be in that 19 to 34 cent range for this 3, 4, 5 dynamic per underlying asset currency unit dynamic. It's a big deal. And even though it's only separated by X amount of percent, it's at this price range that dynamic is in place, and it'll never be in play again once you escalate out of it.
Absolutely right. This ties into the multiples discussion.
Right.
But I finish your thought, and then I have.
That was my thought. So I'm thinking to myself, okay, there is a very strong possibility that the next momentum break in crypto will take us up over 500 billion total market cap, with most likely, if it stays on anywhere near the distribution that it has for the last 2 years, then you're going to see XRP up into that high 50, 60, 70 cent range.
Yeah.
I'll never see the 3, 4, 5 unit currency unit underlying asset unit model again. It won't exist, because the US dollar isn't going to change that much. I mean, it'll lose value over time, but it's never going to get me 4 for 1 again, or 5 for 1 again. Right?
Yeah.
So that's what I was looking at, because this time, I don't know how much longer we're going to be in this space.
Yes. Yeah. And let me tie in perfectly to what you're saying. And you'll like this because it ties in perfectly. I waited to purchase the XRP the original base to buy low. And so I locked in at under 19 cents.
Okay.
So I didn't have high level purchases in light of the market cycle where we were on unit price and so forth. And the fact that we had been waiting for about, at that point, 200 to 240 days of getting to a lower watermark. I felt that the great way to manage risk was to buy in as much as I could, hence the full loan, at the lowest mark that I could. And that's what I did. Now with the repurchase, my price is still about between 20 and 21 cents. So I'm well positioned that way. If you believe what you just said, that bodes well from a risk management standpoint.
Well, for me, I started 2020 with an average cost of 50.
Mm-hmm.
It was 50.36.
Mm-hmm.
And have since came into a little money from real estate. The very last real estate deal will ever have to deal with. I had a medical tourism client that did a ton of stuff down here. I made a little money from that. And I've been able to kind of dollar cost average through this weirdness and get my average cost down to 42 cents. Hence, I'm looking at what is 6,000 XRP at blank, and that's the number I've got to come to. So it appears, if my math is somewhat correct, and I think that it is, but I could be wrong, I think I can get in, if it does get in at XRP down to 23 cents, I will be able to get my average cost down below 40. And that is fantastic to get see, a lot of people, they look at how much money they put in the market, and then they look at the total value of their portfolio. And there's nothing wrong with that. But I think it's important for me, Jerry, to understand what my average cost is, because it helps me make decisions. For instance, leveraging now when I can reduce my average cost per coin is smart. Would I want to take leverage and leverage myself above my average cost? I don't know. It's definitely not as attractive.
Right.
It's not as attractive to increase my average cost per coin, because now all we're talking about is a volume play, and the laws of big numbers come into effect. What's the purpose?
Yes.
I have to ask myself these questions. I'm not saying that's a bad idea. I'm just saying I don't know if it's the best idea for me.
Right. Right.
Whereas
and,
bringing the average cost down is a good idea for me, because I have sell points, because I want to capitalize and I want to diversify to retain capital and produce income. Yeah.
Yeah. And the neat thing is, in our discussion, my experience ties into all the points you're making. In this exact point, I am not motivated to be buying a lot more, because it will increase the unit price. I got it. My average is quite workable at about 20 cents, and I'm not motivated to spend 23, 26, 29, 32 on additional ones at this point. But I want to reinforce something you said. To have a program that, by lending part of your units, so that you can get income from that to offset the loan amount for that which you're using to get more cryptocurrency or to meet other needs, it just makes a lot of sense. That's an element that I have not done yet, but that makes sense.
Well, I'll tell you, one of the issues that I was in my late 40s when I realized, wow, a tremendous amount of my monthly income is going to pay loans that I have, whether it's the loan for the truck or the motorcycle or the credit card or the, did my son's entire orthodontic life. He spent 2 years with an orthodontist. I did that paying on credit. I had credit lines for my business that were revolving. You're constantly borrowing and and paying back and And it was just staggering when I looked at how much of my life is being paid today for money that basically that I borrowed last month or 2 months or 3 months or 4 months ago. And I thought to myself, okay, I'm going to change all this. And so I sold everything. My son moved out. I had no reason to carry a big 4-bedroom place anymore. And I just went, you know what? I kind of looked at everything and I thought to myself, I'm going to get out of debt. So I sold everything, liquidated my life down to 400 pounds worth of stuff, had some equity positions, and scuffled off to Hawaii to work on some organic farms while I figured my life out. And it was through that process of becoming debt free and not having these monthly obligations, whether they be a credit obligation or even just the mandatory life obligations that come with stuff. So if you have stuff like, let's say you paid for your car cash outright, well, that's wonderful. Guess what? There's a cost to carry that car. It's called insurance every month. It's called registration every year. It's called ongoing maintenance, right?
Absolutely, yeah.
You do all these things. Well, I was really walking through life unconscious, never really putting a thought to those things. They were costs of doing business.
Right.
The cost to be an American and have your own home and have your own business, you're going to have this list of costs. Well, guess what? You don't have to. You can opt out of that. And I chose to opt out of that. And I'll tell you, having no debt is the most, at my age, is the most wonderful thing in the world. Yes. That the decisions that I make financially are based off of A, my goals, and B, the reserves I have on my balance sheet.
Yes.
Not borrowing from somebody else's balance sheet, creating a debt situation.
Yeah. I just ditto that. What you said is right on. We did the same thing where we liquidated. We were in Oklahoma. We had 10-acre property out in the country. And basically, when we decided to go to Spain for some community service work, and that was 4 years over there. But in the Oklahoma liquidation event, we just basically sold everything we could or gave it to family and friends or charity. Oh, it was just like being in a helium balloon to be free from all that debt. And to tie it into what we're talking about, with the proceeds of this, I would recommend at whatever stage one is to consider these elements. Number one, and Dave Roberts comes to mind, and God bless him for helping millions of people in this way. But of having that emergency fund that is there because life happens, and that's really critical to make sure that you have that fund in there. To not have any debt, if at all possible, and to minimize it, and then from there to have a very solid income and investment strategy on top of that. And it sounds like you're there. Congratulations.
Well, I am poised to be able to do some stuff with the capital from my investments. I do know a lot of people in this space. We've had private conversations. I won't mention any names, but they're up to their eyeballs in debt. And it's interesting because they're also in this crypto space and they're trying to increase their crypto portfolio. And rightfully so. I still think we're so early that the asset price today is nothing compared to where it's going to go. So obviously you want to get yourself as well positioned now as possible.
Absolutely.
And so some of these folks that have been subscribers reached out to me on Twitter. Some of them we've even started phone conversations and stuff with. They're so in debt that it's like 80% of their total incoming flow is just covering their minimal obligations. House insurances, credit card loans. Some are even still paying off student loans and things of that nature. And they're looking to get capital from the crypto investment in the form of profit to be able to wipe their slate clean. But when you actually start doing the math and breaking it down, they're going to need an exponential blast off in the crypto space for their holdings to even cover their debt.
Wow.
And that's something that all of us should take a peek at. There is no one part of our financial life. Our financial life encompasses the whole enchilada. There is no, I have some crypto stuff and that's completely different than everything over there. The truth is, you're an individual. If you're in the United States, you have a social security number and all the stuff that comes with that. So what other tax liabilities you have, whatever loan obligations you have, what other legal obligations you have on whether it be income or capital going forward, whether you're divorced or child supports or this or that and the other things. People should really take a look at this from a holistic standpoint and really take a look at what's going on. Like I had a guy talking to me, he's like, man, I'm just not finding it possible to put more than this into crypto every paycheck, and I really want to. And we looked at his debt and I thought to myself, I was absolutely blown away. I said, have you ever considered liquidating your stuff? It sounds like you got stuff you don't even really need or use.
Right.
And he goes, well, I like my stuff. And I go, okay, on a level of what you like and don't like, do you like the idea of being completely financially secure and independent, or do you, or do you like being tied to these things? Which do you, I mean, I can understand you like them both. Which do you like more?
Yeah.
And it was funny, the answer he came up with, he wants to be able to move around the world and not be tied to all his loans and all his stuff. Yet he's tied to all his loans and all his stuff. So we make choices all the time.
That's right. Exactly.
And I don't know if a lot of us are really conscious of the consequences of the choices that we make, and that we always have a choice to reverse course.
Yes.
Like you can pay off loans. You can sell stuff and pay the loan off. You know what I mean?
Absolutely. Yeah, absolutely. It's absolutely critical.
You don't have to stay in something if you don't want to be in it.
Exactly.
There are options. And so people have the opportunity, if they open their mind and think about it, I always recommend everybody go back to their goals. What are your goals? And are the actions that you're taking now, whether in your spiritual life, your emotional life, your physical life, your financial life, are they working you towards accomplishing those goals? Or are they creating a barrier between you and being able to accomplish those goals? And only you can answer those questions for you.
Exactly right.
You ask yourself those questions. Now, all of a sudden, like an awareness can happen, and you don't have to walk through certain elements of your life unconscious or feeling like you're stuck.
Absolutely. You're touching something very near and dear to my heart. So I do strategic planning for companies. And in the 90s, a bell went off that said, people need strategic planning for their lives. I wrote a workbook called Living on Purpose. It's now gone out to many thousands and thousands of people. It has 10 categories that covers the areas of your life, from spiritual to practical to relational to community to financial, etc. And it has been very valuable because it's basically not in your face saying you have to do this, you have to do that, but it gets you to define your values, your vision, where you are now, where you want to go, turns those goals into actions, and then tracks it with accountability partner and so forth. And I'll show you that offline. Maybe we can go through it at another time. But it's really cool to have a life plan and to hold yourself to it.
Well, let me ask you this, Billy. Is this something that's online?
Yes. In fact, I'll get into that information with you offline.
Let's make sure that I can put a link in the description of this video for those viewers that went, oh, wow, that sounds really kind of cool. Let me check that out.
Yeah. Okay. Very good. We'll cover that off.
Excellent.
But anyway,
right on.
it has helped a lot of people from, you know, thousands and thousands of college students all the way up to people in our bracket and older and younger. For our kids, I would say from a 15-year-old on up, it's a helpful planning mechanism.
Well, I'll tell you, I don't think anybody, I can definitely recall numerous stories from folks who failed to plan and were faced with catastrophe, as opposed to people that prepare and plan tend to weather things out, right?
Right.
And there's an old adage, and I'm trying to remember if I hope I say it correctly. It's something about piss poor planning. Oh, poor performance. I forget. I can't remember exactly how it went. I had a boss that used to tell it to me all the time. Basically summarized, he'd say the saying, if you're not preparing to win, you're planning on losing.
Yeah.
You know,
poor planning drives piss poor results, something like that.
That's what it is. That's what it was. Poor planning provides piss poor performance.
Performance, yeah.
That's what it was. Thank you very much for that. So I'm looking down here at the clock. I would like to get your last thoughts, and let's target this towards the boomers, because hopefully they're the ones that have hung here to the end with us.
Mm-hmm.
If you were a relatively new into crypto, what would be some resources that you would direct a boomer to, whether it be, you know, something on the internet, something on YouTube, what have you?
Yeah, great question. I'll just cut to the chase scene for me. I've spent now thousands of hours, it's safe to say, thousands of hours in this space, and have determined that XRP is disproportionately the opportunity. That's for me. What's the power in my having said that? If you trust the approach that I may be doing in things, hopefully that provides some guidance. Because like Brad Garlinghouse said, out of 5,000 cryptocurrencies, 1% of them may endure, and only 3 or 5 of them be the new Amazons of the future. And so that means 50 max, something like that. So I would say that identifying experts is very important. And by the way, I'm not holding myself out as one. I do have a list, and I'm also happy to get that to you. I've looked at all of the YouTube, well, not every YouTube channel, but most of them, evaluated them. I've looked at all the websites that are excellent and evaluated those that I found. People that are trustworthy and credible on Twitter, I've identified. When you put those 3 things together, websites, YouTube, Twitter, you come up with a good list. And I have that list that I give to my friends that are serious about vetting XRP. And I'll be very happy to share that with you, and you can attach that later on too, as long as people realize this is just my own personal list.
I have never thought to actually document. I mean, I think along the same way you do. There are sites that I believe are incredible, and there are folks on Twitter that put out really good stuff, and there are YouTube channels that have great content. Yeah. And the same can be said for all those 3 sources where maybe not so much, right? Mm-hmm. But I never thought to document it.
Well, I'm happy to provide that to you, and also you can come up with sub-lists. Who are the ones that have the best, you know, market intelligence type versus technical analysis type stuff. So it's an interesting process, and I recommend it. And you know, and in terms of, I would have to say, and nobody's paying me to say this, but of every expert that I've looked into over the last years, I'd have to say that Tika Tiwari was the best. Now, it wasn't cheap to get his service, but it has proven that the candidates that he mentioned way back in the beginning, most of them have vetted out, and some of them are doing well. So that is a trusted resource that I have. So I can mention that, and I'm not using him currently. It's funny. Quick story on that. I paid for a lifetime update membership, and somehow they lost that file, and so they are not providing ongoing lifetime updates. So I said, sayonara, peace out, we're good. But that happened. But anyway, happy to provide you with what I've learned on this journey.
Very interesting. I think that's wonderful. Folks, I hope that you got something from this incredible conversation with Mr. Bill Bean. And Bill, I want to thank you for representing yourself, but also representing your generation. You know, I can tell you my dad's a boomer, and his entire philosophy towards this space is, Jerry, you handle it. I have no desire to learn about a button on my phone or some, what do you call them? Apps or apples or whatever you have on your phone. I don't want nothing to do with that. Okay, I got you covered. I'll handle it. And it's not uncommon that a lot of my friends that are older than myself, and just by a little, because I'm the first year of Gen X. So if you're born in 64 or below, you're still a boomer. And I have a lot of friends in that age group, and it's amazing. They don't want to deal with it, but it's getting easier and easier and easier to get an Uphold account or a Coinbase account. And they're both reputable enough that if you're not keeping millions of dollars locked up in an exchange, chances are you're pretty okay. You know what I mean?
Yeah, I really agree with that.
Matter of fact, the risk of losing your crypto to to sending it to the wrong address or screwing up with your ledger is greater than the risk of the Coinbase vault being broken into.
Yes, well said.
You know what I mean? So everybody needs to really understand risk analysis. There is no more blanket statements like, if you leave your coins on an exchange, you're an idiot. That's no longer true. You know what I mean?
Yeah, and still there's not an FDIC in the crypto space. So buyer beware, got to be very careful.
That's true. I will tell you though, and I'll close with this, and I do not work for Uphold. I don't get paid in the affiliate stuff for Uphold. Uphold's cash and they cover just about 100%. 100% of your coins on their exchange are covered in cash in a bank somewhere that does have FDIC insurance.
No, that's impressive.
That's very impressive. So anyway, that's enough about that, folks. Thanks for tuning in. I hope you enjoyed this episode of Beyond Moon. And on behalf of Bill and myself, and until next time, Pura Vida.